afternoon once again. It's the Educate Trade to Trade podcast with me, Chris Pollock, and this is
Zee.
And we're going to have a little wrap up of what we talked about last week. We've even got a special guest with us today, a former Chief Economist at PricewaterhouseCoopers. So he's going to run through some impacts on the Trump tariffs from an economist perspective. But so we're going to start with just looking back on real trade action, real price action for the week, and jumping off, really starting on the charts from last week on the S&P 500. We talked about option expiry, how this can be a significant turning point in the markets. Let's take a look at the charts now and have a look at what happened into last week. So we spoke about these potential twists and turns in the markets, that the option expiry often creates this opportunity for like a window of weakness after a long rally. And if you see here, this is indeed quite a nice rally from Trump, well, even through the summer, through Trump, through the start of the year to all-time highs on Wednesday last week. And we were chatting to you on this time last week, Friday afternoon, when I think, if I'm not mistaken, we were around here. All of the action to the downside happened after we put the podcast to bed. But you can see here, there has been blood on the streets of the stock markets. We've been down over 5% from highs of last week to the lows of this. Down on the Friday heavily, down Monday, down Tuesday, down Wednesday, heavily again down Thursday. Maybe there's some hope for it today. What do you think, Zee? Maybe? Do you think there's any life in this thing yet?
I think it will stay in a range. I think it's taking the lows out. We've been looking at it from a 4-hour candle, and I think it will sort of recover from here. We'll see if it does, though.
Well, I can't see it continuing to go down every day throughout the February to March option expiry, but there is a feeling that this might be the month that the markets tend to be weak. Seasonally, this is about the worst time for the markets, or for stock markets at least, and we often get this weakness from mid-Feb through to the first into the second week of March. But from then, things tend to pick up. We tend to have a fairly nice rally into the summer. So we'll see what happens from March. But hopefully a few of you who tuned in last week were able to try and capitalize on that sell-off that we had through the whole of this week, really. There's been plenty of good triggers to come through on that. So hopefully a few of you caught up on that one. What else are the takeaways from last week? Well, we mentioned that Trump was going to be in town again. We said he was quiet last week, didn't we, Zee?
Absolutely.
He was back.
He's back with an action plan. So we had a quiet week of Trump last week. And I was looking for some trading ideas this week. I think I had a frustrating week from Scotland and I couldn't get a trade in. But yesterday, we had this Truth Social tweet sort of Trump put out. And I will sort of zoom into this. He talked about drugs pouring into the country. He talked about Mexico and Canada being tariffed. He talked about twice in the amount of tariffs on China. And this was done at what time? Yesterday, about 1:46
1:46 UK time, yeah. Just half an hour, 45 minutes before the US stock market's open.
Absolutely. So whilst he did that at 1:46, I had my eyes on Bitcoin. Because Bitcoin was looking for sort of the lower end of the chart. And I got in, I had a sell order here that got triggered around, you can say, 4:35 p.m. UK time. And it sort of took an entry about 86,400. And if we can look at the time, from 1:45 p.m. UK time, after that Truth Social tweet, we saw the markets go lower and lower, which triggered my trade here. So I was able to take one of my most profitable trades, Chris, this week.
Good stuff.
And we took Bitcoin down from 86,400 all the way down to 81,454 in this region here. So that's when I closed that trade there with the take profit. So that was a really, really good tweet from there. And then we saw the same thing happen on Nasdaq and ES. A very similar thing happened on ES. So we saw on Nasdaq, we saw the Trump sort of tweet come out at 1:45, and then we started to take out the lows there as well.
Yeah, that was interesting because it's different. If you look at back to the Bitcoin chart quickly, if you sold Bitcoin literally in that 1 minute, 5 minute period and put your stop above that candle, it never touched it again. By contrast, the S&P, I think the Nasdaq maybe to a lesser degree, but certainly the S&P did go and retrade those prices. Why? Because we were so close to the US markets opening, right? We couldn't create enough of a move at that time of day to justify it because all the volume was ready to pour in just over half an hour later. So I think the stock markets were a little bit more coy than crypto, but crypto doesn't work like that. Crypto's just go 7 days a week, right?
Absolutely.
So it's quite a good one to trade on Trump tariffs, because you don't have to wait for the opens to come and go, where you can often get stopped when you get these huge kind of volatility spikes. On volume spikes, you don't get that in quite the same way on crypto. So crypto just went straight down on it, but it took until the open for the door to open.
Absolutely.
And then we're talking about this every time we do a podcast, is how weak things are on Thursdays.
Absolutely.
It seems to be a bad day for the markets this year.
We see highs get taken in the first sort of couple of weeks. Mm-hmm. Then after the couple of days, we see Wednesday blend into consolidation, and then we see Thursdays where the sort of liquidity really gets taken out. And we've seen it twice now in the last couple of weeks.
Yeah.
Where Thursday comes and I go, Chris, are we looking for a short?
We are.
And we
have been. And I'll be doing the same for the rest of until the March option expiry. I think I'll be looking more down than up. But there will be some bounce backs. You do want to not just be shorting into every price.
Absolutely.
You've got to be tactical with your entries here, and there will be opportunities. But as we said last week, you make a lot more money when you short the market. It goes down a lot more quickly than it goes up typically. So if you can just be patient, wait for those entries and get them right, hopefully there'll be one or two more chances for you over the course of this month. Yeah,
so a little comment on Bitcoin before we go to the next thing. So Bitcoin has sort of rallied back up to about 84,000. Mm-hmm. So I'm starting to think, are we going to go take out the highs again and then repeat the same cycle? Because it seems to be the way Nasdaq's been sort of doing it, the ES has been doing it, and now Bitcoin we see in real time here go back to 84K. So could I be triggered into a long going up? We'll get to know over the weekend.
Well, that's it. We'll see what's coming our way. There's a few other takeaways from my week. I know when we spoke to you on Friday last week, we just had the PMI data out in the US. Mm-hmm. And it surprised me because we saw the PMI data come in weaker than expected and stock markets went down. Mm-hmm. For literally since the beginning of the year. Bad news has been good news for the stock markets. We've had inflation fears. If we get bad news, that means maybe rates can come down and stock markets actually go up. Mm-hmm. As of the PMI data, I was away earlier in the week. Maybe it happened slightly earlier in the week too. But certainly on that PMI data on the Friday, we saw bad news was actually bad news for the stock markets, right? Mm-hmm. So when this starts to happen, this is like a change in regime a little bit. We're now worrying about recessions more than we're worrying about inflation. Mm-hmm. We should probably be worrying about both. But yeah, certainly the recession is the focus of the stock markets when it comes to news at the moment. This was confirmed. You don't want to use one data point as your reason to kind of change kind of strategy. So I was very keen on watching the first big release of this week. I say big, it's not that significant, but the consumer confidence numbers on Tuesday, weaker than expected, stock markets down. And we've just had, even this afternoon, we've had the Atlanta Fed GDP now come in negative, stock markets down. So we're now in this new cycle where if you get bad news, stock markets are likely to sell off. And if you're quick on this, maybe not everyone's got on this change in narrative yet. So these are kind of the first 5 or 10 trades which you can take on the indices when the things change. These can be potentially the nicest ones to take on. And this leads nicely into next week because it's a monster week for data next week. First week of the month, always the biggest for news. What have you got your eye on next week? What's the big one for you?
For me, it's the usual, the impact it has on the Nasdaq. Mm-hmm. And the impact it will have on crypto, because crypto's in a sort of tyrant state right now, and I've been getting calls all week. Is this the low? And are you buying into anything? I'm still keeping stables, but it will have a huge impact. The first week has a huge impact. Usually I'm hoping for recovery, but we'll see. We'll see how it plays out.
Well, there's going to be loads of triggers for you here, right? So we've got month beginning happening on the first of what will be the 3rd, I guess, of March by then. But the first trading day of the month will be Monday. So that creates its own thing. We'll talk a little bit maybe now about month end and month beginning and the way these things work. But we've also got ISM manufacturing, ISM services, job openings, the JOLTS data we've got out, ADP figures if you care about those. And then the big one, as always, non-farm payroll Friday. We talked about this, I think, on the first podcast we did. We talked about this. It was all about maybe the Thursday before non-farm, just be a little bit coy because normally Thursdays, yesterday, for example, was a phenomenal day. But if you're a big trader, are you really going to put big positions on Thursday, knowing that when the stock market's open on Friday, the non-farm payrolls data's already been and gone and you might be offside 3%. So just be careful this Thursday coming, but there's plenty of data to create volatility for your crypto trades because they're responding well. And as I say, I think the indices are going to be a really fun place to play next week when it comes to news. Hopefully we get some big surprises, but I've called it kind of bad news is bad news again, rather than good news is good news, because we haven't seen too much good news coming our way of late. So talking about month end, we'll do a little deep dive into what happens at the end of the month and the beginning of the month, and as to why that is. So let me share some work here that was been done by another one of my favourite people to follow, Brent Donnelly, a former trader in the both in the UK and Canada, worked for all these big US banks. If you can name one, he's probably worked for them. And he puts out these messages, these reports each week. So please sign up to his services. It's amazing. And he does an excellent podcast as well. So it's called the Macro Trading Floor if you want to tune in. But this work he did was about Friday the 13th. Do you want to pronounce this for me, Zee, or shall I have a go?
Have a go, Chris.
Trixidecaphobia, I think we'll go for. It's the fear of Friday the 13th and the fact that there aren't 13 floors, there aren't 13 rows on an aeroplane, and how we have these fears around that day. How have I managed to move this? Let's see. Oh, there we go. I'm trying to still get my head around how to use a Mac. I'm struggling.
I'll put it out there and then you can...
Okay, let's go again. This is not what I was looking for. Must be further up the list. Here we go. So, yeah, we see this interesting work that he looked for Friday the 13th to see if the 13th was a Friday. He identified the percentage win rate for each day to find out if Friday the 13th was as bad as everyone probably feared. And he found that actually this was one of the most consistent up days in financial markets. But Thursday the 12th, people getting scared of Friday the 13th were selling this market a little bit more than maybe they should when they came in on Friday morning and realised the world wasn't on fire. They bought it all back. So this seems to be, anyway, an interesting takeaway from the report he did. But the thing that jumped out to me was, well, twofold. One, these Mondays have been pretty horrendous. This is old data, though. This is like 28 to 67. But the thing that jumped out the most to me was the moves that you get at the beginning of a month. Right? These are the most consistent up days. They're the biggest consistent up days. And that's true not just of the data that we get out of the old data, pre-67, but from 1990 to the present day, you can see it's more concentrated maybe, but still the first few days of the month are the days when the stock markets typically go up. If you come in and do some sessions with us, we can kind of talk to you about as to why this is. It is good to understand. But when we come in on Monday, there'll be a lot of people, especially given how far this has fallen, there'll be an opportunity for people to be buying this dip. And there's a lot of money at the start of every month in the pension pot fund that can really lift prices. More buyers than sellers doesn't always put prices up, but when you have consistently more buying than selling over a certain 2 or 3 days, on an aggregate, it will lift prices. And that's indeed what we saw on the S&P there. So hopefully that's a little bit of an insight into how you might look at Monday. There's a few other bits and pieces to look for throughout the week in terms of data as well. So yeah, it might be worth tuning in next week and seeing how that all panned out. But yeah, we're going to move and have a chat with Jonathan now. So keep bearing with us, and we will introduce you to his take on Trump tariffs. Welcome, Jonathan. Nice to have you on the podcast.
Thanks very much.
I understand this isn't your first rodeo on the podcast scene either.
When I was at PwC and the various other places I've worked, I've done numerous podcasts, so there's a wall of shame out there somewhere.
Excellent. We'll find it and we'll post it. Don't you worry about that. So yeah, let me kind of let you get started on this. I mean, I know you kind of recently joined us the last kind of couple of months. How are you finding the trading floor? I know you've not been with us too long.
Yeah, so I'm here part time. I actually also have a sort of like a day job where I'm an economic consultant. But since I have been here, I trade Nasdaq, I have improved significantly. So I'm very grateful to you, to Zee, to everyone for all the help that you've actually given me over the past couple of months. It's turned what has been quite a wild trading strategy into a reasonably profitable one.
Excellent. Well, let's see if we can squeak a bit more out of it. Great. Well, let me open the floor to you. I guess the question is, like, how do economists examine the economic impact of these tariffs? And yeah, maybe you can have a little run through with us and talk us through what you think that Trump is going to do to markets if he indeed does follow through with what he's told us.
Thanks. So I think it's important to remember that this isn't the first rodeo for tariffs in the US. So Trump introduced tariffs on China in his last administration, also on some quite random things like washing machines, solar technology, and Biden actually, for all the rhetoric, kept them in place. And I think over the sort of 4 or 5 years since they've been implemented, they've brought around $200 to $300 million into the US exchequer. So it's quite it's not huge in the grand scheme of things, but if you average that across US households, it's around $200 to $300 per household. So it is significant. This time around, though, it's different. The rhetoric is a lot stronger. The scale of tariffs that are being proposed are significantly larger. And if we just sort of do a sort of ready reckoning, I'll talk about the impacts on GDP in a minute. But I think last time around, economists have estimated that the impact of sort of Trump version 1 tariffs was only about sort of 0.02% on US GDP. So for whatever he said, the impacts were actually pretty minuscule in the grand scheme of things. I think the thing to look at, though, is, well, what evidence is actually out there for the impact of the current round of tariffs? And economists, I think there's always a classic spiel about economists. You put two of them in a room, they'll tell you two completely different things, and you'll probably go out of that room knowing no more than when you went in. In fact, it can actually be quite damaging.
You're not really selling your
economists, but really this time around there's been some quite good work done quite quickly on the economic impact of tariffs, and specifically what Trump is proposing. And what the technique when you're looking at this evidence, the tool that economists are using is called the computable general equilibrium model. So that's a bit of a mouthful.
Right. Do you want to tell me what that means?
I'll tell you. Well, I have a PhD in CG modelling, so I just about tell people what it's about. But what they are sort of large-scale macroeconomic models. They will cover multiple countries, multiple sectors of the economy. They're very big, they're very bulky. Organisations like IMF, World Bank, whenever they have a big economic policy change that is trade-related, will try and run them through a CG model to actually see what the economic impacts are. So if you're looking for studies out there to try and inform yourself in terms of what Trump tariffs will do or any other types of trade policy, then CG type models are generally the best sources of evidence. There will be other sources of interpretation are available and not necessarily invalid, but these tend to be the better and more traditional tools that economists would use in these types of situations. So there has actually been one really good study out there already, and we do actually have a slide, I think, with some of the key results, and maybe we can just put that on the screen. That's been produced by a think tank in the US called the Tax Foundation, and the slide up there just summarises some of their key results. So if you look at the different types of tariffs that Trump is proposing, so tariffs on China, tariffs on Canada, Mexico, EU, what he's proposing on steel and aluminium and motor vehicles.
But maybe not in the UK though, apparently.
Yeah, maybe not in the UK, might get away with it.
But yeah, these guys are in the sights.
Yet to be seen. But those that he's currently announced, signed executive orders, whatever else that he's done, tweeted about, this is kind of like a list to date of what's what's going on, although that list is obviously ever changing. But if you add all of that up, it probably comes to around about 0.6% of US GDP. Where the authors of this paper are a little bit vague on, and vaguer than I would like, is the timeline for that impact.
Yeah.
But you would expect that 0.6 to come off over the next sort of 2 to 3 years, probably. So that impact is spread probably over that timeline in terms of the style of modelling that they're doing.
So you're saying like 0.2, 0.2, 0.2 every 3 years?
Something that will probably be a bit more front loaded.
Okay.
So probably like 0.4, 0.1, 0.1 or something more like that.
Sure.
I would expect. So, well, but what does that actually sort of mean for the US economy? So when, like if you talk about the federal government, they are bound by economic forecasts from the Congressional Budget Office. They are kind of like the official US forecasts. They're the ones that all of their budgeting decisions are made of. A lot of their funding is given on, their spending settlement agreements, etc., etc. So for the current round of CBO forecasts sort of suggests GDP growth of like 1.8 to 1.9% over 2025, 2026. I think those forecasts are a little bit out of date now, to be honest with you. But if you take sort of, even if you spread that impact evenly across the sort of 2-3 year period, say something like 0.2 or 0.6 divided by 3, you know, that's still quite a significant chunky impact, and sort of 10 times more in 1 year than the previous round of tariffs actually caused.
Okay, yeah.
So, you know, that's quite a significant jump in the economic impacts that perhaps the market is. That's perhaps why it's reacting in the way that it's doing. Does taking 0.2, 0.3, 0.4 off US GDP necessarily trigger the scale of reactions that we've had in the Nasdaq and S&P at the moment? The answer to that is no, and I'll just get onto that in a minute. But let's just sort of do a bit of a round tour on you know, a bit more detail about what this type of modelling suggests. So the first thing is that these numbers don't include any types of retaliation. So retaliation is very much on the table. Last time when China retaliated to the first wave of tariffs, economists' estimates sort of suggested that only came in at around sort of 0.01, 0.02% of GDP. So nothing
not meaningful
really,
compared to
meaningful
the rest.
Compared to the rest. But evidence is like the key issue for US households is that these tariffs 100% get passed on into the bottom line. So if you think that the last round took around, or cost sort of households around sort of $200 to $300 on average, this impact could be significantly more, and maybe 2-3 times.
At a time potentially when people are squeezed with inflation anyway.
Exactly, and they will trigger more inflation, that is for sure. So the impacts could actually be quite big in terms of like household spending. Will you see those straight away? No. I think there's a big difference between market reaction and when consumers actually get hit. You're already starting to see US corporates building up inventory so that they can avoid tariffs or the cost of tariffs for the first 3-6 months, perhaps in the hope that Trump will wind them back and that they won't eventually have to pay them. So the impacts actually on consumer prices theoretically should be delayed. We all know that's not true. Any opportunity that a corporate has to put up prices, no offence to the US corporate world, they're already starting to price tariffs in. They're already in consumer prices to an extent. That was in part why I think we got a higher reading on US inflation earlier in the month. It was a bit of a surprise upside.
So the threat of tariffs has
put inflation up. Has already put inflation
But he hasn't even done them yet.
And also you need to think that sort of US corporates probably set prices like once, maybe twice a year. So they've already priced it in now, because if they're actually and they can't keep changing their prices. It costs them money. So that's one reason why that's been done.
Makes me think that if they don't hit these tariffs, then corporate earnings are going to be pretty tasty.
Exactly. And do they put the prices down if the tariffs don't come through? Of course they do. So another thing to look out for there. So let's sort of try and tie this back to markets. So sort of historically, if you look, and I'm just going to have to put my glasses on and read the numbers here because I'm getting a bit old. So a sort of 1% increase historically in sort of a 1% change in US GDP leads to sort of roughly 10% increase in S&P, about 14% increase in Nasdaq. So let's say if we take sort of 0.2% off that, that's conservative estimate. That could hit over the next 12 months sort of S&P Nasdaq by sort of 2 or 3% in terms of like the yearly gains that we would expect them normally to make.
Sure.
So that's sort of pretty significant. That change though is not what we've seen in the Nasdaq in the past month, which has wiped pretty much I think 8% off.
Yeah. Discounts are in.
So what markets I think are really doing at the moment, it's charged by emotion, sentiment, expectation, rather than the real economic impact. And you'll start to see the real economic impact probably through Q3, Q4, possibly into Q1 next year in the earnings reports, because that's when businesses will be saying, well, we had to put our prices up, our costs went up, etc., because of the tariffs. And that's when you know the true impact. What's going on at the moment is definitely sort of like a sort of dawn of realisation that things might get worse. So you could have started to argue that tariffs are priced in, but actually probably not. What's priced in at the moment is the uncertainty, the wave of emotion associated with some of the tweets that Trump is making. It's like markets will push back up as a result. Once things settle down, once actually they start to get implemented, but then there'll perhaps be a slower grind in terms of their impact sort of towards the back end of the year.
Thank you, Jonathan. Yeah, I think there's a lot to be said about the way that he's communicating this, because it will stop being as effective if he doesn't follow through. So for now, these impacts are huge on markets. Whenever you hear Trump tweet or see him do a truth social these days, it's just instant impact.
Yeah.
But if he doesn't follow through, and I think we're expecting, I know the Mexican trade minister was saying they were hoping for a deal on Tuesday.
Yeah.
Well, I mean, we'll see if that comes and goes without one. Maybe they'll get one done and we'll swing back the other way. And as a day trader, this is excellent, right? We want this sort of thing. But as an economist and big picture, that volatility just gets taken out in the end, I suppose.
I think one thing to note is in terms of like Trump's sort of personal measures of success. So when Trump talks about the economy's growing great, he talks about the indices. He doesn't talk about GDP. He'd probably talk about job creation as well. But GDP, he's I think sort of goes above him. If the S&P is doing well, if the Nasdaq's doing well, Trump's happy.
Yeah.
He's a businessman.
Yeah.
So at the moment, because it's choppy and it's lost a lot, question mark at the moment as to whether he's really looking at that. If over the course of the next 6 months markets continue to struggle and there's lots of headlines about that, you may well start to see stimulus packages kicking in. We're not going to get his tax cuts through until the end of the year. And so you have to think, well, everything that I've said here is taken in isolation. This is just the effect of tariffs. There could be other sort of positive stimulus effects from the things that he's doing that will counterbalance them over the next 12 months. Plus the AI revolution rolls on, losing a bit of steam, losing a bit of momentum, but actually it's still very much prevalent, and there's still a long way for AI adoption to go, which could be quite a positive thing still driving markets over the next couple of years.
Okay, well, thank you for that input. Yeah, I think it's going to be an interesting 2025, I'm sure, and we'll be back next week to bring you some more insights. Hopefully we've seen some decent moves on the Nasdaq on this news that's coming through. And yeah, we'll look forward to seeing you again next week. Thanks for joining.
Thank you.